For those who haven't been exposed to his content yet, you will invariably come into contact with it if you continue to learn about trading. ICT is Michael Huddleston, the Inner Circle Trader, who has been teaching his trading concepts for free on YouTube for a few years now, and has been teaching traders for many years prior through his own private mentorship and on the website Baby Pips. The concepts he teaches are also known as Smart Money Concepts, or SMC. The basic premise is that there is an algorithm that runs the market and is programmed to take money away from large institutional traders and retail traders as well, who follow the retail concepts and indicators that are standard inside of most trading platforms. He mainly trades index futures on the S&P and the NASDAQ, but his concepts work on all instruments, including Forex, metals, and commodities. There are a number of ways to trade ICT using options. You can sell options, buy options, or create a variety of spreads. We won't go into the variety of options trades in this video, as there are many videos on YouTube that cover that. The ones that we use are buying naked options and selling credit spreads. Because of the directional nature of ICT's strategies, buying naked calls or puts work well most of the time. Sometimes, trades take longer to develop, especially on the higher time frames. In these cases, it makes sense to sell credit spreads to take advantage of time decay. If you are buying a call or a put, buy at-the-money options because they move more closely with the market because of their higher delta. We won't go into options Greeks, but just know that options with a higher delta move more closely with the underlying stock. If you are selling credit spreads, sell options further out of the money with a lower delta, between 20 to 30 delta is a good place to start. Usually, the value of the option is not enough to make it worth your while the further you go out past 20 delta. We usually buy the second leg of the credit spread 5 strikes away from the option that was sold. This provides enough value for the credit. The best times to trade options with ICT strategies are, of course, during regular market hours. Options are not traded past New York Open and New York Close. The best times are at the ICT kill zones between 10 to 11 a.m. and 2 to 3 p.m. The number of contracts you should trade depends on your account size and your available buying power. When you buy regular options, your overall balance directly determines how many contracts you can buy. When you sell credit spreads, your overall buying power is used to determine how many contracts you can sell. You should use good risk management rules to determine your number of contracts. One way to do this is to only risk 1 to 3% of your account per trades. Here is an example of taking 2 different options trades, keeping in mind your account risk percentage. If your trading account balance is $10,000, you should only risk $100 to $300 per trade. Buying 1 call of Apple. If we're looking for Apple to go up, then we can buy a call option at the 182.5 strike, which costs $132. We should exit the trade once our Apple option reaches our price target, or 2 to 1 of our risk, which is in this instance $200 to $600, depending on how much we want to risk. In this instance, if Apple goes up about 4 points, it should give us the $200 with 1 contract. We can tell by the delta of the contract. The delta tells us how much money we make with each $1 the stock moves. Selling a put credit spread of Apple. If we sell a put credit spread on Apple by selling the 177.5 strike and buying the 172.5 strike, then we expect Apple to go up and we will only get a $66 credit for each option contract we sell. If you have $10,000 in your account and want to risk $100, you expect to make $200 if your strategy is 2-to-1. To receive around a $200 credit, you need to sell at least 3 contracts to make $198. This will require $1,302 plus commissions in your account, because that is the maximum loss for the trade. This doesn't mean you will lose that amount. It only means that the broker needs to be able to cover your trade with that amount. You will manually exit your trade once you reach a $100 loss. The maximum loss is calculated using the width of the strike prices, which is 5 in this case, minus the credit received. The width of the strikes is $500 minus the credit received, $66. That equals $434. If we multiply that by 3, we get the $1,302. If you're looking to day trade options, you need to have at least $25,000 in your account in order to not get flagged as a pattern day trader and to have restrictions put on your account. If you do not have $25,000, then you need to plan your trades each week so you can still get in and out of a trade on the same day. A day trade is when you get in and out of a stock position the same day, and you only have 3 day trades available every 5 business days if you have less than $25,000 in your account. An example of a way to deal with the pattern day trade rule is to trade on Mondays and Tuesdays or Thursdays and Fridays. If you follow ICT, then you know that the high or low of the week generally occurs on Monday or Tuesday, and the low or high of the week occurs on Thursday or Friday. The good thing about trading this way is that you are reducing your number of trades and therefore forcing yourself to only take quality trades. The best stocks to trade options are the ones that have enough liquidity to get in and out of your trade. This is usually the issue when the stock price is moving fast. Here is a list of stocks and ETFs that have enough liquidity to facilitate your trades. There you have it, the best way to trade options using ICT strategies. Hopefully this was helpful to you. If you've enjoyed the content, please let us know in the comments below, and please like and subscribe to be notified of upcoming videos.